Good afternoon, everyone. Thanks for joining during your lunch hour for kind of a review of the New Jersey tax situation after the July budget. There was a question regarding handouts. I was told that the slide presentation that we'll be looking through today is going to be available and provided with the credit letter that will be sent out in a few days. So sit tight. You'll be able to look at the presentation on the screen. If we skip over slides, you'll be able to get the benefit of those when the handouts are delivered. So with that, and before we get started, just a sales pitch for the Society's upcoming state tax programs. There's the regular state tax programs that the State Tax Interest Group provides August 29th. There's going to be a New York presentation. There's also a State Tax Nexus update for September 17. Two big conferences that the Society sponsors each year: the New Jersey Tax Conference at Pines Manor, November 13 of 2018, and then the Multi-State Tax Conference later that month, November 29th, in Island. These are all great programs if you have an interest in state taxes. Participating with the State Tax Interest Group and attending the meetings, if you're able, is a great resource, and I would encourage you all to do that. The budget was passed on June 31st is kind of when they did it. It was Sunday, actually July 1st, that the budget was passed I think it was by the evening. It was an odd procedure that the legislature used. They passed the budget, sent it to the governor, who then began to or continued to negotiate with the legislature. And once they had their budget deal agreed, the governor signed a conditional veto incorporating all of the agreement into the veto message. The veto was then accepted by the legislature on July 1st. So we had this odd set of provisions where you have just the normal discussions inside the legislature, and then also the governor's veto message, which is giving us some guidance as to what was intended through the budget process. About $1.6 billion of new money was raised. Tax hikes on individuals, corporate income were the headliners. Someone observed that New Jersey now has the fourth highest marginal income tax rate on individuals and the second highest corporate income tax rate after Iowa. There was a footnote regarding Iowa's 12% rate that since they can deduct federal taxes, their effective rate is only 9.8%. So New Jersey gets to maintain its number one position. Well-deserved. The Tax Foundation continues to rank New Jersey last overall for the state business climate. So it's a difficult budget situation. New Jersey has a lot of obligations, health care, pension, other obligations that and promises that Governor Murphy has made, and how we go about funding that, whether there is additional money available, other taxes to be raised. A lot of people think that we've kind of bumped up against the limit. We'll see what happens as things develop. New Jersey adopted its seventh amnesty program. That's part of this budget legislation. The amnesty program is set to last for not more than 90 days. It's not a 90-day program. It is a not more than 90-day program. It has to end by January 15. The division had posted a notice on its website on the 17th of July saying that they don't expect it to begin before November 1st. and exact dates have not yet been determined. That would be about a 75-day amnesty period. The taxes covered begin for the taxes due after February 1 of 2009 through September 1 of 2017. The February 1, 2009 amnesty provision kind of piggybacks with the last comprehensive amnesty that the state had. As with those other amnesty programs, relief is given if tax and half interest is paid, half the interest due as of November 1 is paid, the balance of any interest and most penalties are abated. An exception is applied for taxpayers who are under criminal investigation if certified by a county prosecutor or the attorney general. Civil fraud and criminal fraud penalties are not abatable under this program. As with the earlier programs, if you make a payment under amnesty, it is non-refundable. It's expected that the division and the Attorney General office will entertain amnesty settlements for cases pending before conferences and before the tax court. And as with prior amnesty programs, there's a 5% non-abatable penalty. If you recall from some of the earlier programs, there was a dispute what 5% non-abatable penalty means, and in the United Parcel case several years ago, the Supreme Court determined that the legislature did not intend to apply the penalty in situations where there were deficiencies subject to an audit, where the return was timely filed, there were reasonable questions regarding law or facts, and the taxpayer was contesting that routine audit. Failing to participate in the amnesty program did not subject the taxpayer to that 5% non-abatable penalty. It's not clear, the legislative history doesn't address whether to consider the rule of United Parcel as applicable to this amnesty program. My guess would be that it will be applied, but that is all it is a guess. So if you have audits, you may be able to continue to contest those audits without the threat of a non-abatable penalty. Hopefully the division will give us some guidance in that regard. Just a last thing on amnesty. You can see from a graph here that the net collections in the 2009 amnesty were huge, off the charts. It was kind of a confluence of some various factors, some changes in the division's position with respect to some corporate tax liabilities, nexus issues, financial institution taxes. OLS, the estimator of revenue for the legislature, said don't expect anything like 2009. It may be that collections are going to be more in line with some of the other programs, $250,000, $1 million or so. No one knows. Interesting to note, Pioneer, the OLS noted, had in June of 2017 about 450,000 cases assigned to it, of which 215,000 were considered uncollectible by the division. What the inventory is out there for amnesty-eligible deficiencies is a question OLS didn't have a good answer on, so we really don't know what type of revenue to expect there. Before we get into the program and some of the other legislative changes, the Office of Chief Economist publishes a statistic of income for New Jersey, and it included two neat infographics, I thought. And I just wanted to include it. It shows the principal items that constitute New Jersey income and getting us down to taxable income. And we won't spend a whole lot of time. When you get your email, take a look. It's an interesting representation of the relative sources of income that are taxed, the exemptions and deductions, and then the next slide talks in terms of the credits that are available and how much is ultimately collected from the gross income tax. This is based on 2015 information. It'll be interesting to see, for instance, where we have the retirement income exclusion that is going up, the property tax deduction that is increasing, and we'll see how that affects the snapshot going forward. Regarding the gross income tax, there were a number of tax cut and job tax issues raised. That's the federal tax change, and in the basket of legislation that was passed during the budget, the legislature made clear that Section 199A deduction is not going to be available to taxpayers under the gross income tax. As you know, the gross income tax is kind of a standalone tax. It doesn't generally incorporate the federal Internal Revenue Code into its structure. So I don't know that 199A clarification was needed, but if there was any doubt, it's been eliminated by the enactment of that provision. 163J, the interest deduction limitation for large taxpayers. If it's a GIT taxpayer that would otherwise be subject to 163J, it doesn't appear that that limitation, the federal limitation, would apply for the gross income tax. We have continued uncoupling with respect to depreciation and cost recovery deductions. New Jersey is tied back to 2001, and that continues to be the case. So all of the favorable provisions that we had incorporated into the the Tax Cut and Jobs Act, are not transported into the New Jersey GIT. The Division of Taxation has taken the position that individuals receiving deemed dividends under the repatriation rules under the federal law are required to include those deemed distributions in their gross income tax in a manner consistent with the inclusion for federal purposes. I think there's a fair question as to whether the division's got that right. The division, or rather the gross income tax, has a specific definition for dividends. It includes dividend as a distribution of cash or property, and I don't know that that definition leaves room for deemed dividends or deemed distributions, but it is plainly the division's position that deemed distributions are subject to tax, and they're relying on a general provision in the Gross Income Tax Act that says that federal accounting provisions are to apply. So the question is whether the definition of dividend as a substantive matter is subordinate to the accounting provisions or vice versa. We'll see what happens with that. Earlier in the year, ahead of the budget excitement, New Jersey adopted a shared responsibility health care tax. This was to replace the federal penalty tax that would apply under the ACA. It uses the federal rate to determine what the penalty is going to be based on number of adults and family members that should have coverage. There's no penalty if your income is less than $10,000 and you're a single filer, or $20,000 if you're a married filer. One of the things that you're going to want to do is make sure that you're aware of the employer reporting requirements that will most likely be published by the Division of Taxation. The healthcare tax for the New Jersey healthcare tax will become effective for 2019. The GIT changes. The governor included a bunch of gross income tax changes. or the legislature, rather, the governor had wanted a Millionaires tax. He settled for a pentamillion tax, and there are a number of other provisions which we'll step through. Most of these provisions are applicable for periods beginning after January 1 or after January 1 of 28, so in a sense they're retroactive. The $5 million tax, this is a tax on income in excess of $5 million. The rate's now 10.75. The division has published withholding rates that are required to be implemented as of September 1 of 2018. They apply a catch-up rate of 15.6%. There are not penalties for insufficient withholding if you catch up before September 1st. And unlike some of the other Millionaires tax provisions we've seen in the past, there is not a built-in sunset for this rate provision. The withholding schedules, in case you are lucky enough to have a weekly wage of $96,000, is set out in the table. It's interesting to see that I think that truly they expect about 1,600, 1,700 taxpayers to be affected by the new rates. One of the issues with respect to the pentamillion tax are going to be taxpayers with extraordinary income. If you have a closely held business owner that's selling their business at a substantial gain, if you have people entitled to substantial bonuses, does it make sense to try to level out that income over time beginning this year and next? You also have the concerns about estimated tax exceptions. You've got the prior year exception, or you have the prior year facts at current year rates exceptions as well. So if you have a substantial increase in income this year, you may get some relief from the estimated tax exceptions for those provisions. One of the issues that we don't know is how the new rate will affect composite returns. If you remember, number of pass-through entities allow non-resident owners to file a composite return or have the entity file a composite return on their behalf. The rule is that to file a composite return, the regulations require that the highest marginal GIT rate be applied. In the past, where the rate had been increased, the division implemented a two-tier rate structure, applying 6.37% to the lower rate, income under $250, and then the highest rate to income over that amount. We'll see if the division does something similar, or whether all composite returns will now have to use the new GIT rate, the 10.75% rate. We'll see where that goes. Another big hitter item was the carried interest. This is for hedge fund operators, private equity, where they're taking their interest in a profits interest. The idea was that for federal tax purposes, instead of being taxed as ordinary income, these interests receive capital gains treatment. Some people view that as an unfair arrangement, and the division and the legislature has a carried interest provision that imposes a 17% surtax on carried interest rates. That's 17%, obviously the difference between the ordinary income and capital gains rate under the Internal Revenue Code. The odd provision here is that it's not effective now. It won't be effective until Connecticut, New York, and Massachusetts enact similar laws, and the Division of Taxation doesn't expect this to be implemented in the near term. So it is on the books, but it is just sitting there at this point. The earned income credit continues to be increased. It's scheduled for a ratable incremental increase over the next several years to a rate of 40% in 2020. In addition, we have introduced to New Jersey a child-dependent care credit. It's based on the federal credit. If you have income of $60,000 or less and you incur child or dependent care expenditures. It's tied to the federal credit, and depending on your income, the income range that you're in, you get a percentage of the U.S. credit, anywhere from 50% to 10% of the New Jersey to the federal credit, and that is a non-refundable credit against your gross income tax liability. New Jersey's increasing the property tax deduction from $10,000 to a cap of $10,000, increasing the cap to $15,000. It also included a change that clarified that qualified contributions to government-sponsored charitable funds for which a property credit is allowed will qualify for the GIT property tax deduction. What's that all about? If you recall, earlier in the year, in response to the SALT limitation deduction that was incorporated into the recent federal tax legislation, New Jersey incorporated or authorized a SALT charitable fund legislation. And New Jersey was the second state to adopt this, quote, workaround. And the idea was for municipalities, school districts, other taxing authorities to create charitable funds to which taxpayers could make contributions and then claim a credit of 90% against their related real estate tax liability. The law was to take effect July 3 of 2018, and once implementing regulations were adopted, the Division of Local Government Services published a notice in May that said that they were working on regulations, but none have been proposed or released. No proposals have been released to this point. So there are no funds that are being established that at least I'm aware of. The reason for probably the delay or the reluctance to do anything was the government, the IRS's announcement notice 2018-54, where they said that taxpayers need a little assistance in understanding this cap thing and the SALT limitation, and that if there were transfers to funds controlled by a state or local government, and if there was an offset for taxes, that they would look to the substance over form to determine whether the payment should be treated as a real estate tax payment rather than a deductible charitable deduction. On August 2nd, the Treasury sent for review to the Office of Management and Budget regulations. Those regulations have not yet been made public, or the proposal hasn't been made public, but it is pretty clear that, or it's expected, I should say, that the regulations would disallow a deduction treatment for arrangements like New Jersey had in their charitable contribution deduction plan. So we'll keep an eye out for that. One of the other questions about the proposed regulations is, will they go beyond addressing these charitable contribution deductions? One of the things that's presently being reviewed is the possibility of changing the incidence of taxation, state and local taxation, of pass-through income. And instead of pushing that pass-through income liability up into an entity with a view of having that tax deductible as a business expense rather than as an individual income tax expense on the individual owner's 1040s. The idea would be to get the tax benefit of the business deductions. There is legislation that is being worked on. Alan Sobel, one of the members, one of our society members, had originally reached out to the governor. Other commentators and individuals had suggested the idea of a entity-level tax as well. Connecticut, for instance, has adopted an entity-level tax with the view of, again, allowing that tax payment to be classified as a business deduction. In concept, it's pretty simple. There are a lot of difficult questions relating to it, tricky implementation, as I say. You have entities that are either tiered entities or have non-GIT taxpayers that don't have the cap limitations that individuals have. You have different entity level. What entity level rate should you use when you have a graduated rate system like New Jersey has? And so the legislation that is being proposed is the Society has a working group that is commenting on the proposals, and we hope, working with Senate President Sweeney, to have a proposal that would allow the shift of an incidence, again, shifting the incidence back into the entity to recharacterize the related gross income tax liability as a business tax liability. And finally, with respect to the workarounds, New Jersey is one of 4 states that is participating in a federal lawsuit challenging the constitutionality. I don't know that there's much merit to the litigation, but there it is, and we'll see what happens. One last real estate tax item is that earlier in the year, the governor signed into law a new provision that would rebalance school funding at the state provision of school funds. It'll end up rebalancing the tax liabilities, the contributions to the local school districts, and will affect local tax liabilities going forward. There'll be winners and losers. We'll see where that comes out. Let's shift gears, and another big component of the budget legislation had to do with CBT changes. The big revenue item perhaps was the 4-year surtax. There are also some federal tax-related adjustments, and probably the biggest change that we'll be wrestling with, the adoption for next year of combined reporting. So let's take a look. First of all, we have the surtax. It applies to taxpayers with allocated net income. I think they mean entire net income. I think that's what the tax base is, of $1 million or more. If you're over $1 million, then you're subject to this surtax. It's not clear, but it appears that it's a cliff type of a surtax. That is, you take your entire allocated net income and apply the surtax rate, 2.5% for 2018 and 2019, 1.5% for 2020 and 21. That means that if you have $1,001,001, you have a $25,000 surtax where you would have had none had you only had $1 million of income. There's some commentary as to whether that's fair or whether it should be some type of a phase-in, but the way the provision is drawn now, it appears to be a cliff. When the governor provided his conditional veto, he changed a couple of the provisions relating to the surtax. It's not clear from the changes what the surtax base is. I think it is allocated net income, but it's less than clear. I'm pretty sure, though, that that's the tax base. Credits aren't allowed against the surtax liability, and it applies to all CBT taxpayers. And so that raises the question as to whether New Jersey S corporations are subject to the surtax. New Jersey S corporations are CBT taxpayers. They pay the minimum tax. They may be subject to the penalty taxes for building gains or excess passive income. And so we'll have to find out whether New Jersey S corporations were intended to be subjected to the 4-year surtax. It's, again, going to sunset after December 31 of 21. The surtax amount, if it applies to S corps, puts you way over the top. If you're particularly if your S corporation's earning more than $5 million, you'd be subject to the GIT rate plus a surtax. I don't think it's what was intended, but if you look at the statute carefully, I think it presents an issue. The tax legislation talks in terms or addresses the IRS change regarding 163J, the business interest deduction limitation. It applies for larger taxpayers, and New Jersey has the issue of, well, what happens where you have an interest deduction that is already being limited because it may be subject to related party add-backs or something like that. And there's a task force that the state society has that has been looking at all of the corporate tax legislation, and one of the concerns the task force raised was the relation between the operation of 163J and the add-back rules for related parties. And the concern is that this can result in a loss of a deduction under the application of 163J, where the and where you're still being taxed on the income. So there's a concern on how that interplay, or the interplay between those two rules. There are rules relating to how you go about applying the limitation. The statute says you prorate the limitation between both related party and unrelated party. Apparently you do that first, and then you look at the adjusted or limited interest to determine whether the related party interest is subject to an add-back or not. The related party and interest and intangible add-back that is in place, there was an exception for foreign treaty countries. That exception has been revised so that now, in addition, you have to look to what the effective rate of the treaty countries' tax provisions are to determine whether there's a 3% or less spread. If it's greater than 3%, then you have this add-back obligation. Presumably, the rates that are being compared include the surtax, but that's not clear. So we'll probably need to get some guidance from the Division of Taxation with regard to how the spread is calculated for this and the other spread calculations that apply for related party transactions. It also clarifies that the add-back provisions don't apply with respect to combined groups. We'll talk about that in a few minutes. There are a big money issue was with regard to CBT dividends. As you know, you've got the federal tax provisions that had repatriation dividends coming in, where foreign income is having to be repatriated through deemed dividends. Originally, New Jersey had proposed a 9% tax on all taxpayers on all their deemed dividends, based on an allocation that was about 3.12%, which was New Jersey's share of the GDP for the U.S. Big businesses were concerned that this could have raised more than $7 billion of income, and so there was a huge pushback. The legislature pretty much abandoned it pretty quickly, and instead devised a revised dividend received deduction. Instead of having the 100% deduction that we've had for years for 80% or more owned subsidiaries, that exclusion is reduced to 95%. The dividend deduction applies to both paid and deemed dividends, and so you've got the repatriation dividends being included in the entire net income tax base, and you've got a uncoupling of the 965C deduction for certain distributions, and this provision is retroactive back to January 1 of 2017. The dividends received deduction, there's a special allocation rule that applies. We think it applies to just 2017. It's not 100% clear, but the allocation would be based on 3-year average of the taxpayer's apportionment formula, but not to exceed 3.5% of as an allocation factor for the dividend income. The guess is that that special allocation provision only applies to 2016. The statute is not as clear as it should be, but that I think that's the better reading. The statute talks in terms of deemed dividends. It isn't targeted just at for instance, the repatriation dividends or the GILTI dividends we may be getting in the future. And so you may have other types of deemed dividends that could be picked up under this rule. And one of the things the task force, the Society's task force, is looking for is clarification with respect to what they mean, what the statute means when it talks in terms of deemed dividends being subject to tax. And again, there's questions as to when the special allocation rule of 2016 applies, whether it is just during 2016 or beyond. Another change, which is I think more generally applicable to our taxpayers, is New Jersey's switch from for the sourcing of receipts from sales of services. In the past, New Jersey has been a place of performance state. That is, if work was performed in New Jersey, the amounts paid for that work were treated as New Jersey receipts for purposes of computing the apportionment percentage, the receipts fraction. As New Jersey weaned itself off of the three-factor formula and became a single sales allocation state, it became more important to look at, or more consistent with the idea of single sales, to look to market sourcing for the sales of services. And so that's part of this provision of the new law in New Jersey. This is effective beginning next year, January, for years beginning on or after January of 2019. And what it says is, instead of sourcing receipts from services to the state in which the services are performed, you instead look to the states which benefit from the services that are being performed. So you look to where the benefit is received. If the benefit is received in New Jersey, it's a New Jersey source receipt. If it is received outside of New Jersey, the benefits received outside of New Jersey is a non-New Jersey receipt. If benefits are received from a single service in more than one state, there you look to the value of the services to determine how to apportion that receipt, or you have to use some other reasonable method of approximating the allocation. There may be circumstances where it's difficult to ascertain which states are receiving the benefit from services. The statute incorporates some fallback sourcing provisions. If you have non-business individuals who are receiving services, then you use the customer's billing address as the default sourcing rule. With respect to businesses, including sole proprietorships and other types of and entity businesses, you first look to where the order was placed as the default. If you don't know where the order was placed, then you use the customer's billing address. One of the things that has been a problem for New Jersey is that the states that have been using marketplace sourcing, at least we're becoming more consistent with those states. We should have less of a difficulty or less of a risk, I should say, of having taxation or overweighted sales factors because of the difference in sales apportionment rules. The Division of Taxation is expected to be giving us guidance in this area. Hopefully, we'll have it ahead of the January effective date for the sales fraction. Again, this applies to the market sourcing for services. The other big headliner for the CBT is a change in New Jersey's kind of fundamental taxation of groups of companies. In the past, New Jersey has always taxed companies on a single company basis. If you organized as a separate corporation, you were taxed as a separate corporation. You computed your income, you computed your apportionment percentages as a standalone company. And that presented what some commentators viewed as an inappropriate opportunity to play games with a corporation's taxable income within a corporate group of affiliates and with related parties, so moving income out from New Jersey out of the state. In 2002, the legislature tried to address some of those issues with the related party add-back rules and similar types of avoidance techniques, but there was still a concern that perhaps the better way to approach this is with a combined reporting, where you look to a group of affiliated companies and tax that group on the combined earnings that the group had, the combined profits that the group had. That this would be a fair approximation of the economic performance of the group of companies and make it more difficult to avoid tax by moving income from one jurisdiction to another. So New Jersey is adopting, beginning in, again, 2019, combined reporting. It'll apply to any group of unitary businesses where at least one of the members is subject to tax in New Jersey. If you have companies that are doing business or have or groups of companies that are doing business in multiple states, you're probably dealing with combined reporting in other states. 26 other states, the District of Columbia, New York City, all have some version of combined reporting. And so the concepts that for combined reporting that you have should be somewhat familiar. Under New Jersey's combined reporting rules, a combined group, you look to both common ownership and the unitary business of the group, and at least one member has to be taxable in New Jersey. The common ownership requirement is established if at least 50% or more of voting control is directly or indirectly owned by a common owner, and you use the attribution rules, the federal attribution rules of IRC Section 318 to determine who has common or voting control of the group. And then you look to what the group is doing and determine whether there is a single economic enterprise. Again, and the kind of the buzzwords there, are they sufficiently independent, interdependent, integrated or interrelated in their activities to provide a synergy and benefit that produces sharing and exchange of values, significant flow of values among the various parties in the group. The statute provides that if there are partnerships that are members of the group, they will be treated as part of the group for purposes to the extent that the partners are owned by corporate members. There is a provision that says that New Jersey S corporations may elect to become part of a group, but they're not automatically part of a combined group. So when you're looking at what affiliates constitute the combined group, you can look at your New Jersey S corps and determine whether or not to include them. If you want them included, there will have to be an election, apparently. The combined group is evaluated also on, New Jersey has adopted by default a Water's Edge combination. That is, you look to the members of the combined group and determine what connection they have, if you will, a substantial U.S. connection. If they have a substantial U.S. presence or New Jersey presence, then they're part of the combined group. Substantially foreign companies are not going to be included in the group under the Water's Edge combination. U.S. form companies, unless 80% or more of the property and payrolls outside of the U.S. are includable. Foreign entities or any entity that has 20% or more of its property or payroll outside of the U.S. are not. You've got, again, some intangibles, 20% of the intangible income test, and also a substantial nexus with New Jersey test to determine who's included in your Water Edge combination. There is a provision that allows a group to make an affiliated group election, that is to use your corporate affiliation, corporate consolidated group election to identify the members of the group. Alternatively, you can use a worldwide group election. There wasn't much in this statute about who was included in a worldwide election, but if you were to make one of these alternate elections, it's binding for the year of the election plus 5 years after that. It can be changed with divisions per consent for things like substantial changes of ownership, or if there's a substantial change in business, the business of the members, or a substantial law change. Those are the types of things that the division should be considering. There is the concept of a managerial member. That's generally the parent of the common parent. If there isn't a common parent in the combined group, then the group gets to select one. If the group fails to select one, the division will select the common member, the managerial member. The year that the group files is based on the year of 2 or more of the filers in a consolidated return. Otherwise, it's the tax year of the managerial member that becomes the filing period. The managerial member has the administrative responsibilities of filing returns, making sure taxes are paid. Each member of the group is jointly and severally liable for the tax due from all of the members of the group. And for the first year of application, there's going to be a penalty relief available to members with regard to the first year for filing the mandatory combined return. When you're looking at unitary entire net income, you look at the entire net income not only of taxable members but also of the non-taxable members that are comprised within the unitary business. There are adjustments that are made. Kind of rushing through this a little bit, I apologize. And I'm certain that the society is going to have a more comprehensive program on combined reporting, if only at the New Jersey and multi-state conferences that we introduced earlier on. So, again, the combined reporting provisions is something that we're going to have to get familiar with over the next several months and geared up for planning in 2019. Let me just see if I can jump a bit here. A couple of other CBT changes. We've got a research credit. New Jersey now is going to conform with the federal research credit rules. Before it was tied to the rules that were in effect in 1992. It's a non-refundable credit, and those change of rules will now apply for years beginning after 2018. There's a new film and digital media credit that is restored. New Jersey used to have one. It's back in place. It's an oddball credit in the sense that the rates are different depending on the counties that you're doing the production in. Atlantic, Burlington, Camden, Cape May, Cumberland, Gloucester, Mercer, and Salem get higher rates than the other counties in the state. There are restrictions on credits available to reality shows. They have to be based in a UEZ, and the film has to indicate that it's been filmed in New Jersey, produced in New Jersey, in order to get the credit. And a verification report by an independent New Jersey licensed CPA is required to claim those credits. The governor had expected or had requested to restore the 7% sales tax rate as a part of the budget. The legislature was unwilling to do that. It's probably about a $500, almost $600 million difference in sales tax revenues. One of the reasons that the state was able to maintain the 6.625 rate was because during the budget discussions, the U.S. Supreme Court had made its decision in Wafer versus South Dakota, which changed the way sales taxes are collected, or will change the way sales taxes are collected. So one of the things that the legislature passed as a part of the budget, it's still sitting on the governor's desk, is Wafer legislation. The legislation that was at issue in the Wafer decision, the South Dakota legislation, included provisions that required some minimum connection with the state. If you recall, in the past, sales taxes could only be collected by sellers that have physical presence in the state. South Dakota said that rule was antiquated, especially in the light of internet sales, remote sales, and remote sellers. And it's changed the rule to say really what it ought to be is some minimum connection. They set their legislation at $100,000 of sales in a year, or 200 or more separate transactions. And if you met either of those thresholds, then you had an obligation to begin to collect sales tax, even if you were not present in South Dakota. The Supreme Court agreed with South Dakota that reversing its decision in Quill and National Ballas Hess that said that a physical presence was required under the U.S. Constitution's Dormant Commerce Clause, and instead said that there is a sufficient contact if you meet these thresholds in South Dakota in order for South Dakota to be able to require the collection of tax from the purchaser. And so a number of states have taken the lead, or taken South Dakota's lead, including New Jersey, and have adopted those thresholds, which is, again, part of what A 4261 does, is adopts the South Dakota thresholds for subjectivity. This has been on the governor's desk for a while now. Again, it passed on July 1st. I'm not sure when it was transmitted to the governor. He has 45 days within which to sign the bill. If he doesn't sign it, it automatically becomes law. And so we would expect something like this. There may be some veto issues that he's dealing with. We'll see what's going on there. One of the things that, let me just jump one further. One of the things that this legislation also does is require not only remote sellers to collect tax, but also marketplace facilitators. Here you can think Amazon, eBay, Etsy, who allow sellers to come in to their website, sell goods. It uses the facilitator collects the money from the customer, remits it to the seller. If the facilitator is collecting the money and paying it over to the seller, then that facilitator is going to have an obligation to collect sales tax, New Jersey sales tax, unless the seller has it has proof that the seller was registered to collect tax itself. In that case, the remote seller has to collect the tax, even if it's using a marketplace facilitator. One of the requirements, or one of the things that South Dakota had, was that it was not a retroactive provision, and indeed this bill isn't retroactive. If it's signed, it's scheduled to go into effect October 1, 2018. It's not clear. Maybe the governor is going to push that back a little bit to give the division and taxpayers time to get their feet under them on this issue, but we'll see. Right now, the legislation calls for an October 1, 2018 effective date. In addition, there's a couple of oddball taxes that were picked up, again, in a sense, largely related to the Internet. Transient accommodations, this was a fairness tax. It was viewed as the Airbnb tax, where people were renting out on a transient basis accommodations, houses, rooms, etc. If that's the case, just like a hotel or motel, the rental is going to be subject to sales tax and occupancy taxes, including local government taxes. A transient accommodation is defined, and really the key there is that you are renting the property for less than 90 consecutive days. If it is less than 90 consecutive days, it's viewed as a transient accommodation. There are a couple of exceptions, again, dormitories, campsites, cabins, etc. There is one exception for private residential properties if you don't provide common hotel services, and if keys are furnished by a off-site real estate broker. Which begs the question, if you are renting your own shore place and you make arrangements with the tenant to deliver the keys, etc., it seems like you're subject to the tax, that the only way to avoid the tax is to engage in an off-site real estate broker. So we'll see where the division goes with that and what type of clarifications the division will be able to offer. Relating to transient accommodations, we've got the marketplace type of provisions, again, the Airbnb, where Airbnb is required to collect the tax for the property owner or the landlord and remit that tax to the Division of Taxation. There are also record-keeping responsibilities on the transient owners. There is an Uber Lyft surcharge, 50 cents, 25 cents for shared arrangements, for ride sharing. Again, this is scheduled to be effective October 1 of 2018 as well, and this is going to be remitted by Uber or Lyft. The e-cigarettes are now subject to a 10-cent per milliliter nicotine tax. The governor is also looking for a substantial tax on medical marijuana, or there is a tax on medical marijuana that's subject to the sales tax now. The government's looking for a 25% excise tax on recreational marijuana. That's going to be probably graduated over a couple of years as it's implemented, if it's implemented. So, again, I think we've well earned our reputation as one of the more difficult tax states in the union. One last tax that we'll talk about is the bag tax, which is on the governor's desk, 5 cents for each single-use carry-out bag. A supermarket chain, drugstore, etc., is required to collect. If you bag your own groceries, I don't know how they keep track, but there is the operators entitled to keep a 1% service fee, and 3 cents of the fee is dedicated to the Healthy Schools and Community Lead Abatement Fund. Again, this one too is scheduled for October. It's still waiting governor's action, just like the marketplace Wafer Legislation is. With that, I think I've squeezed out a whole hour of your time. I appreciate you taking your time, taking your lunch with me. And if you have questions, my email's on the first slide that you'll be getting. You're welcome to send me an email or look me up and call or email. And I look forward to seeing you all at one of the conferences upcoming. Thanks so much, everyone.